Welcome back to the Applied MMT live stream. Glad to have you all back this week. Going to be a good one. Going to be answering a question or discussing a topic that I get asked quite often, which is, can you go into more detail on the DeepMMT model, how it works, how you can apply it to an investment process in terms of kind of the thought process, what all goes into it. So that's going to be what I spend the bulk of tonight discussing. And yeah, any of your questions as well along the way, I will absolutely interact with. But 6 months ago, let me pull this up, I posted this tweet right here discussing or showcasing the forecast. So if you recall, 6 months ago, we were at the very bottom of the major sell-off that happened when Trump had come into office and kicked the tariffs on, and realization was setting in terms of what was actually going to happen in terms of the macroeconomic outlook, and we had this big sell-off. And I made this post saying, hey, look, DeepMMT throughout the entirety of the selling was calling for much higher returns for the S&P 500 than what we were seeing through the end of February to the end of April. And it turned out to be spot on, right? And of course, the question is, if you go to Twitter and you look at the timeline of this, you will see this being the post. You'll see that I have quite a few receipts here of over 2 years worth of forecasts that DeepMMT has made. And it's got a great track record. So, obviously people are curious of how this thing works, and I'm happy to explain it. So we'll be doing that. I'll also look at kind of my other flagship model, which is the Minsky flow phase classification model. I've looked at this a few other times in the past, but I want to give it a little bit more time just in terms of the theory and kind of how it works, and how would you use a tool like this. So that's what we are going to be discussing, at least in this stream today, in terms of the things that I planned to talk about. If you're in chat, say hi. Make sure you're, do mic check for me and that sort of thing. Make sure you all can hear me. But thanks for showing up. Today is going to be, one of those evergreen type streams that I will point people back to, because I know I get this question quite often. Okay. Probably worth starting with some headlines. Of course, the government shutdown did come through. Frank and HW, thanks for hopping on, saying hi. Good. Glad the audio's doing good. The big headlines for now will go with the government shutdown. So obviously that did happen on the 1st of October, and now it's how long will this thing last? And correct me if I'm wrong in chat, but I think the situation here is, after so many days, as of right now, at least what Trump is proposing is that he's going to start making hard cuts to federal employees, and they will have the ability to do so. And I think I saw something like after 30 or 60 days or something like that, that'll end up taking place. So a couple things here. I made a video earlier this week just that this transition into October is already seen because of the tax strain that happens at the end of September, and then on top of just year-end sort of funding issues and cleaning up balance sheet issues that happened at the fiscal year end, and really this happens every quarter, but particularly a lot of things are happening at the exact same time that we're seeing liquidity issues, and then add to that the fact that some of the spending that would be going out is going to be paused. So in other words, there's a reserve shortage in the financial sector right now, and there's going to be a reserve shortage that would normally fill in the gap starting at the beginning of October. So as federal employees are temporarily furloughed or laid off. And so the longer this lasts, also if it becomes a permanent shutdown, really begins to weigh on the underlying situation that is already brewing with regards to financial markets, particularly kind of the risk asset equity side. And so the longer this lasts, the greater the implication, or the greater the potential is that this is kind of lasting damage compared to most shutdowns, because usually after the shutdown is over, the back pay hits and all is well. And it's just like it never happened, but this time is a little bit different for the multiple factors that we've seen. At this point, I think over the past week, markets were up about 8% in that kind of time frame where I thought we'd start seeing volatility hit. So we haven't seen the big volatility push yet, but it isn't, at this point, I'm not seeing anything that is making me believe this should be faded at this point. That'd be my call, be faded, and that we get back to bullish. I still think that call stands. So this is kind of one big thing that is on my radar that I'm paying attention to, is how long the shutdown ultimately lasts, and what the implication is. At this point, we're only 2 days, reporting days into the data, so it's hard to draw any huge conclusions in terms of spending. But I will be this weekend kind of spending some time. For those of you that are AppliedMMT Pro members, we'll look at this in the next update. If we can glean anything in terms of like just a minor slowdown of reserves, and that would just add to the overall pressure. And we'll get some more data this weekend too, when the SOFR rate gets published, to see kind of where we're at. And the next week we'll also get what the reverse repo market looks like as well. So for kind of the premise of the video I made earlier this week, we'll be able to tell in a little bit more depth where we are at that point. Hi, does the Treasury still do buybacks? It's a good question. I don't know. Let me maybe I'll I don't know. Can someone chat GPT that, Matans? Yeah, I would imagine the plumbing. Well, yeah, I mean the plumbing of the financial markets and everything is still going to operate, and there are still things that happen during a shutdown. I would imagine. I don't know. That's a good question for ChatGPT to see if there's any information out there. Yeah, because if anything like that, if any of the plumbing stuff has to get paused, that can cause issues as well. The other question too, and again, like I said, the other question, or the other kind of headline before we get into the details that I want with this stream to cover, is what's going on with the tariff situation. To me, again, I think this is probably the biggest. Let me move my head temporarily here, and there, I'll put myself back. But just this is kind of the next big thing that I'm watching. We'll know likely mid-November what's happening here, but if the tariffs don't get overturned, right? If Trump is allowed to go forward with these tariffs, it is I can't express enough how catastrophic I think this will ultimately be, and it'll just solidify all the kind of bubble looks that I'm seeing in the data, and I really think puts us on track for a 2026 top in this cycle, meaning about 6 months later the crisis kind of emerges, whatever that crisis is. For now, I think it's likely just going to be kind of a financial asset collapse, a la 2000, right? So like a dot-com bubble type thing. I don't think we're in line for a 2008 type catastrophe, but being that so many people right now, their entire net worth, their entire 20-year future, I'm thinking a lot of the boomers that are in retirement now, are all wrapped up in the valuation of the S&P. Now, more than ever, a dot-com bubble type collapse could be more catastrophic to the kind of financial future of the country than maybe it would have been in 2000. But tying this back to the tariffs, I do think if the Supreme Court does rule in favor of the tariffs, does rule in favor of Trump, that it is just too much of a drain fiscally to offset what will be the contraction in credit come 2026. And that's really what it boils down to. It's just a simple math equation at that point. Can the amount of government spending at that point in time offset the contraction in credit that has taken place? And if that is the case, or if that is not the case, I should say, then earnings, PE, growth expectations, those all begin to quickly dry up. And that's when you get a massive revaluation lower in asset prices. And like I said, I'm moderately convinced that top happens in 2026, almost regardless if the tariff thing happens or not. It's just a matter of magnitude of how bad does it get. And at this point, all of our models are showing that it could get pretty bad, and will get really bad if this tariff thing doesn't get overturned. And even then, with this tariff thing, you could still kind of make the argument that the damage is already done, that the rest of the world has seen what's happened with the tariff situation, and they're just done trying to export to the U.S., which just means the real terms of trade are going to go back to purchase power parity. Just means essentially that a shorthand way, or I'm sorry, a long-term way of saying kind of the inflationary aspect of the tariffs will still end up following through, and the simple fact that the price of the goods and services that we used to import. So I'm thinking, a lot of the appliances in our house, a lot of the electronics that we get, at least in the U.S., thinking specifically here, that a lot of that will be much more expensive relative in real terms relative to what it was pre-tariff, just because there's no incentive for the rest of the world to suppress their currency relative to the US dollar. And that's just going to make things more expensive to import in real terms, right? In real terms. And whether that shows up in like screaming inflation or not, it remains to be seen. Another thing too, I don't have it pulled up here, but it does look like Trump is trying to push for possibly a $2,000 or $1,000 or $2,000 stimmy check from the tariffs themselves. So, I mean, a bizarre way to go about this. Someone in his administration has to be telling him like the mechanics of what he's actually doing. But I guess they're enough, the electorate is gullible enough to maybe not get it, to think, oh, I'm getting free money. And so they'll be happy with that. But if that were to happen, then I think that actually does get very inflationary. We still, top in 2026 at some point, but we top with a big inflationary wave in that direction. And maybe that is just saber rattling for the Supreme Court to go along with the tariffs, to say, hey, look, yeah, we're just going to give it right back anyway. I don't know if that would influence them or not, but just kind of some political theorizing. So those are the two headlines, and that I wanted to cover before we kind of get into things. So let's do this now. Let's get into the nitty gritty here in terms of DeepMMT. And again, the big thing here is we made this forecast back in May, made quite a few forecasts over the past few years. How does this thing work? What's the thought process? And what I really want to do first, what really needs to be done first, is we really need to think things through theoretically, right? From a kind of macro financial theoretical basis. And then once we get that piece of it down, then we can then we can move on to how do you actually build a model out of this? Because I think that is, at least the interactions that I've had and the questions that I've had with regards to people that clearly understand how to build like deep learning models, neural networks, that sort of thing, to do function approximation, to get, some sort of model to spit out something. I think where it's just, and it's just too hard to have these conversations on Twitter, but where I think they have to think first is theoretically, why are you gathering the input data that you are? How are you gathering it? Like why would a neural network be able to approximate any function out of this data for your target data? And then with that, how are you structuring your model anyway? Like what are you trying to get the model to see, to accomplish in that? And then finally, when you train your model, how are you rewarding it or punishing it based on your understanding of how things are supposed to work? And if you noticed, as I was going through each one of those ideas, each one of those concepts, it all just boils down to, do you have the correct macro theory, right? Because you could be pulling things in like M2 or other data that people just love to look at that is really so downstream in the causal chain of what pushes stock prices, that there's just no mutual information shared between M2 and the S&P. And so there's nothing for this model to learn, and there's no way to bake theory into it. But if you get the correct theory, which we'll go over in terms of what I think is the correct theory, then you can build a learning model that can actually do what it is you're attempting to do. So in this case, I have a specific theory that explains or helps me explain why we get the return profile of what the S&P is. And with that theory, then I can gather the correct data that I think best explains what the outcome is, bake that theory into the model, and then get the outcome that I'm looking for. Now, I'm not necessarily saying, I want to be very, very clear for those two that are really coming at this from kind of a philosophical, theoretical aspect. I don't want, although I think it lends a lot of credence to the truth of the underlying theory, it doesn't necessarily prove the underlying theory. Also, if you get a income or an outcome that's not exactly what you wanted, it doesn't also necessarily disprove the theory. It just means that you're not giving the model enough information to kind of fully realize the theory. But at the end of the day, the game here is to be right in your forecast. So that is what it is that I am ultimately trying to do. I see some good chat. I will get back to chat. It looks like I got some answers with regards to what was happening for the various balance sheets, the Treasury, the Fed. So that's good. And then I also see Kevin Hawthorne. Yeah, thanks for joining, man, from Lakeland, Florida. I think it's hotter here in Michigan right now than it is in Florida. We are having some beautiful weather up here in the Great Lakes state. But yeah, thanks for saying hi. All right, on to the main point here. Let's do this. What I'm going to do in the most simple terms possible is try and explain, and this is going to help us answer what you'll see here actually is these three things, right? So eventually we're going to get to this kind of neural network idea, right? Like how does the actual model function? And what we really want to do is discuss these three things. What is the input data that you're using? What is the structure of in this case, the neural network or the model that you want to use? And then what is the loss function that is going to essentially decide if you hit the target or not, right? And in order to answer those three questions to build a successful model, and again, I mean, I'm going through this in slightly simple terms. This is pretty much it. I mean, this really is. We have to understand what it is that we're actually trying to model and why we think this thing functions the way that it does. So to kind of kick things off, like what it is that, what is it that I'm trying to forecast? And what I'm trying to forecast is the returns of the S&P 500, right? So I am trying to forecast this specific time series outcome that is more than just the S&P 6600 or S&P 6700, but I'm looking for the forward return of the S&P 500 at any given point in time, and that's an important function of this, that I'm not looking just necessarily to forecast the level. I'm looking to forecast what the return looks like over any amount of time. And my argument would be that there are two things that are effectively operating that are determining what is driving that specific return over time. And there are two elements to this. There is an economic cycle that is ongoing, and there is the specific flows that are happening. And those are two kind of distinct cycles that are occurring underneath the hood of the macroeconomy, if you will. But those both are driving what the price of the S&P, what the return price of the S&P 500 is going to be over time. And I say this and I preface this with the fact that I get questions that kind of get at the aspect of, yeah, but this model shouldn't work because it's not all about flows. And I'm, my argument here is, yeah, I know, and I'm not saying that it's all about flows. I'm saying that the return profile, the forward return profile of the S&P 500 that I'm trying to forecast is a combination of multiple inputs that are working together in a complex system that have, all the emergent behaviors that we've talked about and all that good stuff happening underneath the hood, and that it's a combination of all those things that is producing this outcome, but that the main drivers that we care about, or that at least are the most determining factors that are going to give us the most amount of information in terms of what the return is going to look like, are going to be, where are we at, or what is happening, or what is playing out in the economic cycle. And then what are the underlying flows to determine that? And the reason for that, and I wrote this out, I usually don't take these sort of notes ahead of time, but I think it's so important to get this right. And I chat GPT this just to make sure that I was getting the language perfect and how I wanted it. So I'm going to start with, because I just happened to do it in this order while I was writing this out, but I'm going to start with like this idea of price and risk relationship determining the price. And I'll just read this verbatim. The S&P 500 return, it probably should have said return, can be seen as a reflection of how markets collectively price futures earnings against the perceived risk of owning those earnings. If the index is rising, so if it's going up, it often means that the market believes the underlying company's earnings are more secure, or that the required return for taking on that risk is lower. And this idea, it goes back to this idea of like a growth and inflation type cycle that, when the market goes up, what it's essentially saying is that the risk of owning that specific asset is going lower. And so we can kind of begin to think, okay, if in that aspect of, and if you're familiar with kind of risk parity and those sort of concepts, you're immediately going to, some of these phrases are immediately going to make sense. But what is it that we would want to know from this aspect to know that the risk is increasing or decreasing of markets, right? And how does that relate to the overall business cycle? And the major concept here, and then maybe to actually just bring in this idea of thinking about input data, neural network structure, and loss function, is that in a growing market, let's actually just go back to say the end of 2022, right? In that situation, it was, markets had been beat up for an entire year. The S&P was, the return profile for the last year was extremely bad. Obviously, we had a whole sell-off for an entire year. The perceived risk was incredibly high for holding the S&P 500 at that point in time, in part because of just where we were at in the macro cycle. And the idea is, of course, not to just understand where we are at, right? It does me no good to understand where we are at today. The idea is, can we forecast where we are going, right? And how do we forecast where we are going? Well, one of the biggest ways that we can do that is just through that kind of initial cycle, right? The actual flows themselves. That'll let us know where the growth in inflation is going to come from. So we'll flip to the other side of this coin. But then in and of itself, the cycle as well lets us know, right? I mean, as growth continues, that creates more money, which begets more growth, which then feeds back into eventually more inflation because costs go up, labor costs go up, input costs go up, and there's this complex system that is showing us now that maybe we are in maybe flattening growth but still rising inflation, and that puts us then into a different category, a different risk outlook, right? And so while the market is pricing in risk at the end of 2022 because the S&P is just so low, we want to get data and we want to build a model that shows us, okay, what tells us where this growth inflation, where is the business cycle going to be over the next 6 months, over the next 6 years, and what are the drivers for that, and how would we capture those dynamics in the first place? So what's the input data, then what's the actual way that we want to capture that input data, and then how do we put that as a loss function? Here's kind of the first theory in terms of building a model that you want to think about is like the input data that we talked about. Obviously, the core drivers are just going to be flows, but then also maybe how are those flows turning into, say, actual GDP growth, right? What is the pass through ultimately in terms of how what the relationship that goes into GDP growth? How about things like inflation or wages, right? Those would be other aspects of input data that's going to tell us how this entire system functions. And it's also not just a point in time, right? And this is, the work that I do with Ty Keynes over with Modern Macro Technologies is that no, it's any given level over time, right? It's the flow that creates the stock, not just the stock or the flow itself. It's the dynamics that happen over time that you actually have to measure. So you're not just trying to measure a specific point in time and the relationship between that point in time and some sort of outcome that happened in the S&P. You're trying to get a window of dynamics that are taking place from the history, right, that have already taken place, and then what was the outcome that happened after those dynamics, right? And that's, so that's what you're trying to learn from that aspect. And so that is the first kind of element to this, and that is in terms of what is actually creating the return of the S&P 500. It's what the market thinks the risk is of holding that asset. And I love this idea, and it took a while for this to really hit in, but the intuition that it builds is very valuable here. Is that just the higher this thing goes, the S&P goes, the essentially what the market is saying is the lower the risk is that it's going to get that return that is being priced in, right? And that what you're trying to do is essentially say, wait a second, when the S&P is, let's just say a couple years from now at 8,000, and you're saying, no, I'm looking at the underlying dynamics, and I don't think this is the actual return. Like the risk is far greater that we don't actually see the full value of this return profile. The The next part of this, and it really kind of gets to the more MMT side and probably the more important side, is the fiscal and the credit cycle, because these are the two main drivers of the actual money in the system that can ultimately price this thing, right? So, I mean, the S&P 500 at 6,700, whatever it closed at today, is only relative to the amount of money that is actually in the system, right? I mean, if you were to divide all the money in the system by 100, you drop the S&P 500 by the same amount. And furthermore, if you doubled the amount of money, eventually that would push its way through to just effectively double, as we saw in the post-COVID era, double the amount of value of the S&P 500. So I'm going to put this down as what I have on the screen right here, and I'll highlight this so you know what I'm reading off of. Another dimension is the sheer amount of dollars that are in the system. If there's a lot of money being created via that fiscal flow or credit creation, that can also just push the index higher because there's now more capital chasing after these assets. And again, now let's just think about this idea from what input data is needed, what kind of structure would we want, and then what kind of loss function would we want. Well, the input data is quite simple here. It's just fiscal flows and where credit are at. And this part is quite straight to the point. The biggie is always going to just be, what does fiscal spending look like? And then how does that follow from the actual credit cycle, right? Or, what is the credit cycle? And again, the theory here is, and I know I've gone over this quite a few times, but for those of you who are kind of relatively new to this concept, is the macro cycle works because the government, when it spends, it is essentially, that is like the first mover of what capitalism is. It's creating the profits necessary for the capitalist system to fight over, right? So when Apple comes out with a new phone, they're doing that in hopes that they can get part of the pie of profits, their slice of the pie of profits, and their willingness to invest, which by investing they're creating new bank loans. I mean, even if they aren't in an aggregate sense, the macroeconomy is, which creates more money, which pays the workers that can then buy the phone and create the profits, right? So that first mover is the government spending creates the profits, adds to that profit pool, which then kicks off the investment cycle, which creates the credit cycle, is kind of the accounting, the accounting evidence of it, which creates more money, which boosts the profits. And so you get this government spending that kicks in, this kicks off the credit cycle, and that then loops back into the actual valuation of the S&P, both just directly, nominally, just because there's now more money, but also now thinking back to the other aspect of it, which is this then drives that economic cycle. And these then are the two inputs, the two broader inputs into the idea of how the S&P 500 is actually priced. So it's kind of the underlying theory, and all that in thinking through that entire process through this idea of now building a model like DeepMMT and what DeepMMT is actually going to do. So now that we have that kind of under our belt, so to speak, what I want to do is think through or go through effectively how DeepMMT is actually built, and with what we just talked about in mind. So we've got, just imagine now you have multiple layers of input data, right? So just imagine the most important input data, right? You're going to have your fiscal flows, you're going to have your bank flows, you can maybe even measure inflation or where GDP is at, and down the line maybe try and tie those together so the model knows that there's kind of a causal relationship there and kind of how you want that causal relationship to look. Some of the other things too, on the shorter run, if you think you need this in terms of what it is you're doing, maybe you could look at flows and how they're landing in the actual financial sector. So I mean, a good example is what we're seeing right now with regards to kind of a shortage of reserves. Those are all the things that you could be tracking in your model, right? Some of the other things too that I just have in there that are tied in there is a bit kind of adjacent inputs to the larger process, or things like oil, the price of oil, because those can kind of give some mutual information on the impact of the overall price of, or the overall impact of things like fiscal spending and that sort of thing. So, but just imagine you have that long list of input items, and what's going to be important here, and what I have kind of sketched out in terms of the way the model works is, you want, and how it actually works, you want to grab an amount of data that is sufficiently long in time. So 6 months here is just kind of what I have as an example. So on the top here, this might be fiscal, credit, oil, something like that can give the model enough information to understand how these dynamics work, right? Because the model needs to learn that, as we were just talking about with like the main idea of how the business cycle works, that government spending is going to cause the credit cycle to take off, which will cause the inflation cycle to take off, and you want a sufficient window of information for that model to know, okay, there's a causal relationship between all of these, and that is, there's some function that tying all these together creates the output that we're seeing, the forward-looking return output that we're seeing of the S&P 500. So what's going on is we're looking at a historical, how the training works. You look at a historical 6 months that then is forecasting a future 6 months, right? And these are, sliding windows. So you're looking at a historical 6 months of data. What does the outcome look like 6 months into the future? And these move along, and that's effectively how the training works with the model, is it's trying to understand how are these dynamics working out. Now, in and of itself, essentially almost what I'm explaining is some sort of like linear model, right? I'm not at this point. I'm just saying at this point, try and, or what I guess what you could assume that I'm explaining is just a linear model, but it's not. We'll get to how we kind of get there to understand that there's some nonlinear dynamics here, and there's kind of an underlying complex system. But to begin with, you're taking these kind of time series steps and forecasting outcomes, and you're hoping the model can pick up on the fact that there are underlying dynamics of the macroeconomic kind of truth that you think is actually driving the markets. And one final thing here too is, and again, it's important, if this chart right here is the S&P 500, just the level of the S&P 500, what I want to point out too, and this is kind of a trick that I learned through, the hard way. You want to forecast returns. You don't want to forecast just the level. What you're trying to do is say that the change over time of your input variables, so fiscal and credit and all your other input variables, the change over time have as a causal function into the future some sort of change on the change over time of your target variable, in this case the S&P 500. So for those of you trying to do this at home, there's one hint that I will give you that can get you in the right direction. The final piece to this puzzle then, which is kind of thinking through how you can build up a model like DeepMMT, is to focus in on this loss function. And the whole idea is when you build deep learning models, you're building a function approximator, right? So you're building, you're telling the neural network, hey, do your best job. Like, I've got this input data, and I claim that the output is this, some sort of return area. There's some causal link here. So the input data should cause some sort of output data. And I'm going to give you all this historical data to train on, make it work. I mean, it's going to make it work, and it's going to give you what the function is, right? So the returns, the 6 month forward return to the S&P is some sort of function of a combination of all of this. Well, what the loss function is doing is it's saying, okay, I've got this, I'm throwing darts at the board, right? I'm doing a bunch of random trials here, and I'm throwing some darts at the board. And if this, if this throw right here hits the bullseye, then whatever function was used to throw that dart or to shoot that arrow into the bullseye, that's likely true, right? And the loss function is just saying, if I got close to the answer, how much do I want to give to that set of solutions to the function? How much weight do I want to give to that, right? Because maybe you get a different arrow that also hits very close to the, in a similar in a similar fashion to the bullseye. Let's say they're equal distance but slightly different. How do you want to weigh each one of those, especially if they got there in two kind of different paths, right? One being the path that comports with reality and the other that doesn't. And that's where the loss function comes in. And what's cool about loss functions is you can just embed in the loss function a understanding of the math or the theory that you are getting at. In other words, you going back to this, shooting the arrow at the target, you can say, hey, look, if this arrow got to the target by, doing a loop-de-loop that completely defied the laws of physics and then hit the middle, I want to absolutely punish that specific outcome, that specific answer, that specific function that it came up with, and say, yeah, no, it needs to at least comport with physics as we know it. And if it doesn't, then I'm going to just go ahead and reject that. And in fact, if this arrow, even if it misses, it's very far off the target, but it followed the actual rules of physics, I want to think that that's closer than the one that was perfect and hit the target. And so from a loss function standpoint, you can start to embed some of your theory of how this should actually work. I mean, a great example of this is just that government spending causes the credit cycle to take off. You can express that mathematically in the loss function and say this should hold true, right? This should hold true to a certain extent, given other variables, right? And so that's the idea of going all the way back to how do you actually fit a underlying theory into a learning model that then gives you a specific outcome. So at this point, I think that I've at least explained the underlying features of what DeepMMT is. And I've been seeing a ton of chat go off, but I think all of it is with regards to government spending and that sort of stuff and debates on that aspect. So I'm gonna hold off going to chat and just kind of continue now. How do you actually use these tools knowing what it is that they actually are? And I'll say, and let me go back to the actual screenshot of DeepMMT from 6 months ago that I had posted. And I got some feedback on this in terms of, okay, admittedly, it did not see the big sell-off happening throughout April that ultimately played out because of the tariff, call it kind of the tariff tantrum that happened. And the reason that it didn't call that is simply because the model is in no way built, now that we understand how this model is built, it's just not built to catch what are called exogenous variables, right? And this specific model, I don't want trying to catch those, right? I have other ways to essentially take those sort of scenarios into account and apply, whatever sort of trading or investing hedges or whatever I might need, like in a situation like that, to that. What I want DeepMMT to do is tell me, given where flows are at, given where we're at in the business cycle, as we talked about, and given historically how those things have played out relative to the return profile that we saw in each one of those instances, give me the likely outcome, the most likely outcome in the returns of the S&P 500. And what's nice about that is if my theory is correct and I'm confident that I've built the model correctly, then something like what played out from March and April in the sell-off is that I can feel very confident that that is just a massive mispricing, right? If anything, it's just a massive buying opportunity. And, when we got to the end of the sell-off in April, and DeepMMT is saying, I think at that point it was 6,500 that we were going to see by October. And again, I'm thinking literally when we were right at the bottom, eventually it started to start to pick up as we went on in time and got up to the 6,700 target, close to that 6,700 target that we ultimately got to. If DeepMMT is saying that, then I can feel very confident that I'm not missing anything and that it really is just an exogenous shock and that this is just a massive mispricing, right? So if I'm confident that my theory is correct, that I built the model correct, then this shouldn't, the sell-off shouldn't bring me worry. It should bring me a buying opportunity, right? Which is exactly how things ended up playing out. Now, if if it wasn't an exogenous variable and markets really started going in a different direction, then that might be maybe a bit more investigation that needs to happen in terms of why we're seeing this big mispricing. But I mean, ultimately, it was right and it played out. So I think what I want to get at least with DeepMMT, and what I would want to explain is this is one tool in the toolbox that is serving a very specific function. Now, it's just turned out that, it's a great tool, right? I mean, it is, it really is kind of a tool that can solve quite a few problems, but it is one tool in the toolbox, and there are other tools that you want to pull out when doing your analysis that can show you different aspects of the market that this one thing can't capture. And this one thing is capturing some really important dynamics, but it's still, it's still just a slice of the overall picture. I am now seeing chat asking for my opinion. So how about this? Can someone summarize what's been going on? Portfolio managers need to make money now, please. I don't want to have discussions. I want Douglas's opinion. Matans, can you just give me a summary of what it is that that's going on, and I will try and give you my best thought here. Okay. The next thing is that I want to talk about. So there were two tools, DeepMMT. That is the first, and I call it my flagship model. It's great. It's done everything it's needed to do. The next model that I've pieced together that I wanted to go over tonight, and maybe it might actually be worth. How about this? I need a breather from thinking. So give me 1 second. I'm gonna pop back over to chat. Actually, let me just go through chat here real quick. More bonds buybacks means more money to banks, funds, holding. Okay, so it looks like we're talking about bond buybacks from the Treasury. Is that the overall? Yeah, someone's just gonna have to summarize. I'm trying to get the gist of this discussion, but someone's just gonna have to summarize what the discussion is, because I am not gonna bore everyone with me just reading through chat for the next 20 minutes to get this figured out. But yeah, Django, chat is lit. I agree. Okay. The next thing I want to talk about or discuss, or at least kind of show off, is, let me just pull it up here, is the flow classification model. And again, this is one of the other kind of main flagship models. Okay. He believe bond buybacks stimulate the stock market. I guess if you want to make that argument, one way you could make that argument, I guess I will hang out here on chat, is that in a certain specific environment, if reserves are heading out to the financial sector, and the financial sector is short on reserves, I don't mean they're like shorting reserves. I mean they have a less reserves than they would like. In that specific instance, like we're likely in right now, in that specific instance, the reserves could help the balance sheets, right? But that would be a short-term, temporary support, not some, it's not adding liquidity. It's not adding money to the system. It's just changing the composition of the money that's in the system that may or may not, in that specific environment, help the balance sheets of the financial sector. And you could also go the other way, where if there's a shortage of collateral, like treasuries, and banks really want to be holding those because they need those for expanding their balance sheets, then you could also go the other direction and say that treasury buyback of outstanding treasuries is actually reducing the amount of collateral at an inopportune time, making it more difficult for the financial sector to increase its balance sheet. So my general my general kind of heuristic on this with regards to anything that like the Fed and the Treasury are doing with regards to the makeup of outstanding assets is that it's just that for purposes that are important to them, right? And they might be legit purposes for the institutions, right? Like for example, the Treasury might want to buy back bonds because it doesn't like how much interest it's paying, or it needs to lower its costs because the federal government passed a certain spending budget and it needs to lower the cost or whatever, right? Whatever reason it thinks, or it thinks that it can impact longer term rates by 1/8% or something like that, right? And so they can have their legit kind of political policy reasons for wanting to do that. But in no way is that going to change the total amount of effectively risk-free financial assets that are in the market that ultimately lead to the total valuation of the market, because they're all the same. It's effectively all the same thing, right? They're just doing asset swaps to facilitate specific policy outcomes that support what they need to do or what the other banks in the financial sector kind of want at that time. But it's not going to change the trajectory of like the long-term trajectory of what would have happened given the buybacks or not. I hope that's helpful. So why increase the frequency and size of buybacks? I assume that's to me. The frequency and size of Treasury bond buybacks can help artificially pump equity markets by providing more liquidity to middlemen holding bonds. In certain circumstances, potentially, yes, right? Like, but it wouldn't change the long-term path that we were on. I mean, it would just, instead of going zigzag, it just goes zag-zig, right? Like in the end, we all end up at the same spot. But what I want to be, what I don't want to in any way come across as saying is that Treasury buybacks are like adding on net more financial assets to the private sector. They're just not. Don't see any tension forming between Fed and Treasury, and that the Treasury is attempting to force the Fed into some action. Yeah, I'm sure there's tension there. Yeah, I don't really have much more to say. Like the Treasury saying, you aren't lowering rates, we'll get money into the equity markets. Yeah, I just think more than anything, they just want rates to come down above all else. I mean, that's all I'm getting, which whatever, if that's what they want to do, that's what they want to do. And it's not like it's like that substantial. I mean, I saw Trump post that picture of like mortgage rates, just doing the y-axis crime, right, where it makes it look like mortgage rates have dropped 100% or whatever 110% since he took office, but they've dropped, I don't know, 50 basis points or whatever. And I don't see that as all that substantial in the grand scheme of things, but whatever, maybe they do. He gets to post a meme, so he's happy. All right, next up, let's talk. Might have even made sense to start here, but let's talk the Minsky flow phase classification model. And the best version of this in terms of kind of receipt that I have, this is actually one of the first models I created. I've got to go all the way back to 2023, the beginning of 2023. This model, it was I built it a little bit differently back then. I've modified it. I think there was a little bit too much noise in the model, but the same underlying structure of it remains. But at the beginning of 2023, it called, and I think this is in, when did I post this? January. It was looking for markets finally to turn thoroughly bullish. And so that's, what this market is doing is essentially, is the name, or what the model is doing, as the name implies, it's called the Minsky flow phase classification model. So what we're trying to do is classify within the phase cycle, and it really is kind of this credit, as we were talking about at the outset, this fiscal credit cycle. Where are we at in that cycle, right? Where are we at in that overall phase going forward? And the concept, as we talked about at the outset of the stream, really just goes in line with the fact that as fiscal increases, that is going to increase credit, and eventually fiscal is going to fade relative to the overall impact that it has on growth, and credit is going to win out. And then when credit finally begins to decelerate, that means that we're likely at the end of the cycle. And once the cycle pops, that's when fiscal will pick back up because of the automatic stabilizers, government spending, that sort of thing. And then the government loves to get into get into action, take action when the economy is doing bad. And so you get all this spending, and that starts the cycle up all over again. And you can see this very much play out in terms of, like, if we look at the credit cycle, you can see it cycle. It goes up, it goes down in cycles. And quite often, as it thoroughly accelerates into the end of the cycle, that's generally when it's most likely that we're going to get the kind of bubble to pop. And there's some well-defined math behind this. You can only accelerate for so long before or I guess probably the better way to put it is you can't get infinite acceleration. Eventually you'll get the deceleration. And then if there is a sufficiently large amount of private debt to GDP, so the private debt share of growth, even just a mild deceleration can actually be enough to prick the bubble. And then you see a collapse. And then on the fiscal side, every time fiscal drops in terms of its own rate of change, right? So now fiscal is no longer adding to growth, it's all credit. Every time you see fiscal go negative in terms of the rate of change, that means that we are now fully reliant on that credit cycle that we just talked about. And when that credit cycle then finally tops, you're in the kind of the sweet spot for economic calamity to take place. And that's why every time this thing goes negative or near negative, you end up with a recession not too far after, because you're now just fully reliant on that credit cycle, and that credit cycle eventually rolls over. What's really cool is you can actually visualize this, and I put this in a little 3D scatter plot. So the three axes of this, again, are this idea that there is a fiscal cycle, a credit cycle, and kind of how bad it gets is how much the credit cycle is making up of the total amount of GDP, so private debt to GDP. And let me pull up that last chart. And so, part of what I'm arguing here is the more private debt to GDP takes up, the more sensitive the financial sector is going to be to a slowdown in credit. So, for example, the recession in 2000 was bad, but it was obviously not as bad as 2008, right? And it was more contained in kind of the direct, the dot-com bubble stocks, the financial sector, whereas at nearly 180 or 170% private debt to GDP, the great financial crisis, found its way far beyond just the financial sector, right? It was hit Main Street much worse. And so currently, kind of where we're at, I would imagine if we do end up getting a top to this cycle, that it would happen probably, again, more akin to what we saw in 2000, not only just because of where we're at with the private debt level just being lower, but we were just a little bit smarter, although this is quickly changing, about letting the financial sector bleed into kind of Main Street. So those are the three axes of the plot that's on here. So on right now, private debt to GDP left to right. As this thing moves left to right, we're moving to higher private debt, meaning the outcome of the crash, if you will, should be worse the further this thing goes to the right. Now on the y-axis here, currently on the left, that is government spending. So kind of how we're looking at this, you can now see that fall in government spending into 2000, that fall into 2020, that fall into 2008. So you can see those three big time periods when when government spending went low. And then I added that little plane right there at 0 because I think it's just so important to see. Now, if we do just the credit itself, and again, this plane kind of helps us just look right at the credit part of it. You can see that as we are accelerating, so we're going higher into each one of those cycles. And what the red dot is, or what these dots are, is the 9-month forward return of the S&P 500. So, once we hit this moment in time, what happens to the return profile of the S&P 500 into the future? And in each one of these in each one of these instances that where we kind of peak, that's just saying that red was a bad outcome for the S&P 500. You can just kind of see that this is the 2000 zone, this is the 2022 sell-off that we had, and then this is the 2007 2008 sell-off that we had. That's when things got bad. So what you can do is you can then turn this very noisy visual model into a very simple model using some machine learning techniques, and that is exactly what's on the screen here, just to let you know. And this is, to me, this is like always my sanity check model, if you will. Like if I think things, for whatever reason, if just in my own head things are about to get really bad, but then I come back to this and I'm like, okay, this is just where we're at in that cycle. It helps me ground. It's a first foundational model. I want to know where we're at now. Since I made this post on Twitter back a year ago, I got rid of one of the cycle areas and just made it to 3, a lot less noisy. And generally how to think about this is as the model marches upwards, green just means that we are in the Goldilocks zone of the credit fiscal cycle. Yellow on the way up means that we're getting into more of the bubble territory. It doesn't mean the cycle's over. It just means that we've probably gotten to that point where credit is taking up more and more of the actual part of the cycle, meaning we're more susceptible to the market finally turning over. And then when this thing finally flashes red on the upstroke, that means that we're probably at the end of the cycle and crap's about to hit the fan. And then it reverses on the opposite end, right? So red will hit, we'll have the sell-off, and then eventually we'll get back to maybe we might hit a brief spot in the yellow zone. But at that point in the recovery, it just means that credit still might be going lower, but now we're starting to get that fiscal recovery. So you just also have to be kind of directionally aware of how this model is playing out in terms of the credit cycle to really understand what that middle phase is actually trying to tell you. And that is building upon everything we said throughout the live stream. That is kind of the second foundational model that I like to have, or the flagship model that we run with to really help us know where we're at and then the underlying theory. So with regards to the tools and kind of the 2 flagship models that I built over time that are true kind of learning model type or machine learning type models, those are it. That's the underlying theory and what it is that we are trying to what we're trying to ultimately pull off. So if there are any questions at this point, now would be the time. I have one thing I want to finish with. I think I just pulled it up on screen on accident. Professor Doug is true form. This is a real clinic in modeling. I assume you mean data modeling, but maybe you mean male modeling. I don't know. Thank you, Mr. Spicy Salsa. Amazing. Thank you. So this is what I'm going to leave you with in this live stream. I really want to get at this, and this, I guess, chat, this just kind of goes out to you. And if you have any thoughts, DM me. I would love to be pointed in the right direction here. In terms of this, what are your predictors for when the current bubble we are in burst? The top predictors, yeah, good question. The top predictors are really just that acceleration, like the amount of acceleration in credit that we're seeing. For me, we will almost certainly be on the doorstep of a recession when this chart goes negative and credit is accelerating. There's just no way around it, right? It is just a matter of the math that when credit is accelerating above 7.5% to 10%, when it gets to that range, and fiscal drops in terms of the rate of change below 0, there is just not enough. The way the feedback loops work for the credit cycle, there's just not enough continued acceleration that can happen, and enough fuel for the fire to ever continue that cycle indefinitely. And that is what I'm always looking for in terms of when that bubble pops. So fiscal sufficiently slowing, credit sufficiently accelerating. And my guess when that happens is in mid 2026. So that would be the bubble popping. Now the crisis takes, maybe 6 more months to, fully realized, right? Because like I would say the bubble popped in late 2006, 2007 in terms of the great financial crisis, but we finally saw the the crisis itself fully materialize at the end of 2007 and then obviously through 2008. Same thing with the dot-com bubble, right? The bubble maybe topped mid 20 or mid 2000, but the worst of it didn't happen for a few more months until after that. Yeah, Netty though, the problem is he has. that's the problem, is government spending is dropping, and it's dropped sufficiently enough. We are just we government spending has to be accelerating, and at this point, as of today, we're not. We are right on track at the same time last year, and as the where did I put it? Yeah, I mean we are like this based on our models and our projections. This chart right here, come mid 2026, will be right here unless something changes, right? So we will repeat exactly what we saw in 2022. Mid 2026, we will be. Well, let me just do this. I'll literally spell it out. We'll go here. This is at the current pace. This is how this is looking, right? Like we will be here mid 2026, and at that exact same time, the credit cycle will zoom in a little bit on this. The credit cycle will look like this. And we will be exactly, based on my math, we will be exactly where we don't want to be come mid 2026. Probably the best way I've ever shown it right there, to be honest. Like that is kind of where we're at. So I'm just, to me, that's why I think we're getting, in a bubble or close to a bubble at this point in time. Yeah, what 1 month doesn't, like it's about relative to prior spending, right? Because going back, to the outset of this, right? What the pricing in of the return profile of equities is, what is the risk of holding this, right? And as the S&P 500 goes up, that's what, essentially we're having the market tell us that it thinks the risk of lowering growth is minimizing, right? That's like what has to, that is what a rising S&P 500 tells us. But what I'm saying is that come next year is going to be grossly mispriced because of where the cycle is headed. When interest rates go down enough, do you see private credit expanding? Yeah, I do. I do think in this specific pocket right now, you could absolutely make the case that a rate cut will, especially in like housing, right? I mean, I would imagine that a lot of people have been holding off on buying a new home. I mean, this is just, kind of my gut feeling on it, but a lot of people are holding off buying a home until interest rates go down. And I bet, yeah, if they can get interest rates to go down just a little bit, that would absolutely help things out, especially too, because we're seeing this acceleration of credit, meaning there's more money, meaning that if you have more money and prices are lower, you're going to want to buy at that point in time. So yeah, because, and the reason like this is true now is simply because the Fed is going to be, usually the Fed cuts rates pro-cyclically, ironically, but now they're going to cut rates counter-cyclically, but now they're going to cut rates, pro-cyclically. In other words, usually they cut at the most inopportune time at the end of the cycle when you really what you need is more fiscal more than anything else at that point in time. And by doing so, they actually reduce fiscal. Well, now like the biggest inhibitor to credit expansion is just the cost. And so right now, the idea would be if you cut rates, it's going to just reduce the cost. So, the cost itself is the main driver in bringing down interest rates will just bring down the cost. Yeah, so I did see that he's floating the stimmy check. Yeah, I joked on Twitter that few of you might remember this. I'm dating myself here. I was alive at this point, but we once had a president shut down the global economy, shut it all down, and then reopen it right back up, and then caused just a massive market sell-off in a massive supply chain issue. And then he just handed out $1,000 stimmies to everybody. And ironically, what's amazing is like Americans hated this, right? It resulted in runaway inflation. And the guy that did this was able to blame his predecessor for it. And they reelected him. And then he's doing the exact same thing all over again. We get to replay 2020 all over again. It's going to be wild. So yeah, I mean, I think, here's the thing. If the stimmies do go out, I think it's just going to be a massive wave of inflation again. Probably not to the extent of the post-COVID era, but very similar, maybe. And it could even get that bad. I mean, it really could. It just, in part this time, at least in real terms, just because of the damage that's been done from the dollar and the whole export thing. So there's absolutely that aspect to it. Okay. Last question. Last thing I want to bring up before we head out. And I just wanted to touch on this. Please DM me if you have some thoughts on this. Normally I'm pretty concrete in terms of how I'm thinking about this. Part of me just doesn't affect the way ultimately I'm going to do anything. But whatever. I spent time on it. I listened to this podcast about kind of what came first, or how did money emerge, made what apparently Bob took as a smug reaction, which is sweet, if I ever get a time machine and go back 20,000 years, I'll have the perfect framework for understanding economics. Because to me, the idea that like barter kicked off a common unit of exchange that then turned into kind of the fiat system we have, from a purely just fun to study human history and anthropology is a neat conversation. But in terms of how that changes absolutely anything of how you would model a modern economy, to me is completely irrelevant. And he had this analogy of it is cool, right? Like, two chemists are trying to find out how life started and they both have a theory, right? We should want to do this. And my thing was, I actually think you could just have, using his how did life begin, his analogy hold true that life just began twice on Earth, and like barter maybe turned into money in some instance, but that doesn't mean that barter had the system that we have today had to emerge from barter. And the final question that he had, and the other thing too is, and I mean, this is just kind of neat that it happens. Like, we see social scorekeeping or bookkeeping, especially amongst animal partners, in terms of reciprocity, where if you don't, if you don't scratch my back as well as I scratched yours, then like this relationship is going to break down. That it's like that we have witnessed, without the need of hard money, like value determinations on reciprocity within like the animal kingdom. So that's kind of the first aspect I have of this. But what do you have in this? It's just where where I need your help. That he's saying that I continue to dodge a central problem in the narrative, which is, to Graeber's credit, acknowledges, but then hand waves away. How do you convert different types of obligations into a common unit? And I thought about this, and I think, and this is where I had to do a lot of research, or not a lot, because I have other things to do, but I did do some research, and this was tricky. Why do you have to convert different types of obligations into a common unit? Like, why can't you just have a web of obligations that are constantly changing relative, the value of one another relative to that web, right? So the point is, and this is just, I mean, to me, I look out at the world and this is what I observe. And then the outcomes that happen are the outcomes you expect given what your observation is. if there's like for me in America, I go to American banks, and like that's the system that I have. And the government spends, and to a certain extent, the fact that my currency is what the MMTers are saying is true, that my currency is a tax credit, and it takes the reality that I could go to jail for not paying it away from me. So I earn these things, and then whatever the government buys, that sets some sort of relative value, and then you have this other kind of web of obligation. So it's like one obligation. Then you have this other web of obligation that is just like the overall credit system, where banks are going to create money and they're going to intermediate the counterparty play between me wanting something that you have and you wanting this money to be created to facilitate that, and such another layer of obligations. And then this exact same system is happening in Europe, it's happening in Asia, and all of these things are constantly finding some sort of correct price level as all the various inputs, not only in terms of just kind of the what I would call kind of like the core flow inputs, but also just kind of the social human inputs. And why do we need a common unit in that web of obligations? And my point being is, I think in the way I see it, like the outcome of how the system playing out from my vantage point is that you would expect market fragility, price, collapse, right? You'd expect exuberant bubbles and all that sort of stuff to happen if there is no common unit, right? Right, like you never find an equilibrium that emerges, and I don't know if that's what he's saying, but I think that's what he's getting at. So, if you have any thoughts, let me know. But I think my answer to Bob is why do we need a common unit? Maybe that's just how I'll respond, but that's my question for the day to finish off that I'm thoroughly curious about, is this idea of why we need a common unit. But hit me up on Twitter if there are any articles or anything I should read. I ChatGPT'd it for a while to see if I could figure it out, and it all just came back to things that I just don't think really matter. Let's see. What else do we got? Nicholas Gomez, private debt is too high to service, is always the cause of recessions and bear markets. Yeah. It's probably a good way of summarizing. Yeah, there's just not enough money into the system to service the debt. Probably a good one to keep an eye on. Okay, that is what I wanted to touch on for tonight, kind of the high notes. And yeah, if anyone ever asks about DeepMMT, we now have the video to explain it. If you watch this after the fact and you weren't in chat, make sure you just go ahead and hit me up on the comment section, and I can answer those during the next stream. And then kind of as always, if you are an active trader, active investor, we've had quite a lot of bangers recently in terms of the updates. Head on over to AppliedMMT.com to sign up over there, get access to these tools like DeepMMT, Flow Phase. And then on top of that too, we have a data dashboard that breaks down the data in the way that I think is most important, the best way to look at all the various flows and everything, and kind of mini models in and of themselves in terms of how they work. So those are all over there. And then also just the main core models, DeepMMT, and then the Flow Phase. And the other two models that I have that are still kind of like the flagship ones are the vol shift and the sentiment flow. But everything's over there. So again, active traders, active investors, head on over there. I know chat's been popping off, and I'd love to keep it going, but I do need to wrap it up. So get subscribed with the notification bell, and we'll go live again, and we can pick up the chat. I actually will read chat and maybe get a Chat GPT summary, so I can go over some of the topics in the next live stream that were touched on in chat, and spend some time there, because it does look like some good discussion was going on. All right, crew. Thanks for tuning in. I appreciate it. And yeah, thanks for going off and chat. It was good. It was cool. It was cool to watch. A little distracting. I wanted to get in on it, but I had some promises to fulfill with regards to what I wanted to cover. So Thanks everyone for tuning in. As always, good trading and follow the flows, and we'll talk to you next time. Have a good night, everybody. Have a great weekend.